Welcome back to the final round. Just about 43 minutes left in this week. Right now, the Dow is holding on to some relatively meager gains after being up nearly 300 points. At least it's out of the red here. Nasdaq's off just about 1% as we continue to see some declines in big tech and also some of those other companies that we were just talking about that posted what people thought were pretty good earnings, and we are not seeing it carry through today. Names like Peloton and also Chewy. I want to bring in Ed Yardeni right now. Ed Yardeni is President and Chief Investment Strategist at Yardeni Research. So Ed, just to start off, I'd love to get your take on the character of this market right now, because of course we all know the incredible rally that we've seen here. I've been reading your recent writings, and it seems like you actually think the action right now is pretty good. It's healthy to kind of have this pullback. Is that right?
Yeah, I'm definitely in the healthy correction camp. And I would have been more concerned if this market just kept going straight up. So I'm glad to see this correction, and ideally it'll just consolidate, which will move sideways for a while, allowing earnings to catch up.
So I want to ask you about MAMU. I was not that familiar with MAMU, the mother of all melt-ups. Now, if you're on the right side of it, I guess it can be pretty good. Yep. Some people got to live through the MAMU on the front side of the .com bust, which was the downside, and long-term capital was part of the whole puzzle in your thinking and other people's thinking that led us to be able to have this asset bubble increase. And you're writing now about Softbank possibly getting us to another one of these melt-ups. Can you help me figure this all out?
Yeah. I think there is a question of whether Softbank might be comparable to long-term capital management, which blew up in late 1998. Market took a little bit of a dive on that news. Actually took a dive in 1998 on the Russian default, and then LTCM had some problems. But that actually led the Fed to provide more stimulus and solve the LTCM problem, basically bail out the institution, though a lot of people at the company lost their jobs. But that then set the stage for what was then the mother of all melt-ups. We saw a tremendous increase, over 200% increase in the NASDAQ back then. This time around, it's been more like 70%. I don't think Softbank is going to be comparable to long-term capital management. That LTCM was highly leveraged in all sorts of derivatives. From the press accounts, what I glean is that Softbank bought a lot of stocks in the tech sector, and then bought a lot of calls on top of those stocks, and had some substantial gains. And for all I can tell, they've just been taking some of the gains, cashing them in, profit taking, rather than being forced to actually bail out with losses. So I'm not concerned about it at this point, but I do think we've had an extraordinary melt up until September 2nd from the low on March 23rd because of all the easing that the Fed provided. So that's kind of a similar with what we saw in the late 1990s.
Ed, Dan Roberts here. Speaking of the tech pullback, I've been asking all of our guests because in the last week or so, you see a little bit of a split on what's going to happen next. Some thinking this is just a momentary correction and thus the same mega tech names. And then I guess also you could throw in the tech names that have been seen as stay-at-home plays amid the pandemic are set to continue their surge soon enough once the correction has kind of happened and is set in. Others think maybe we're done seeing those mega gains for the big tech names. Where do you stand?
Well, I think it's all going to depend on something that investment strategists and stock analysts aren't terribly good at predicting, and that's the course of this pandemic. Much will depend on the vaccine that is being developed. As we know, there's over 100 vaccines being considered. I think 3 or 4 of them are in phase 3. There's been a setback on one of them. But if we get a vaccine within the next few months, and then we start to distribute it, let's say sometime early next year, then presumably some of these tech names have had this extraordinary run on the view that we're all going to have to stay home for a long time, work from home, get educated from home, and get our entertainment from home. Suddenly that may not be quite so plausible, and the market may simply broaden out as tech stocks take a breather and other names start to advance on the perception that the economy is going to finally be able to put this pandemic behind us. So it all really depends on the virus situation. My view is that tech stocks got a little bit ahead of the fundamentals, even if we're going to find that the pandemic lasts several more months, even another 6 to 12 months. And they were overdue for a correction. And there's still so much money out there that even if money comes out of tech, it's got to go someplace. I don't think it's going to go into treasury bills earning zero. So I think we will see a broadening in the market. Maybe we're seeing some of that right now.
And when you talk about how there's just so much uncertainty, it's all tying back to when we get a vaccine, when we could put this pandemic beyond us. If we are in this situation for another 6 to 12 months, like you said, we could be. How critical is it that we get another round of stimulus? Because at this point, it doesn't look very likely that we're going to get anything before the election. Is this something that the market needs, do you think?
Well, we are certainly continuing to get ongoing stimulus from the Fed. The purchases of the Fed by treasuries continues, and the Fed's balance sheet, at least in terms of their holdings of treasury and mortgage-backed securities and even some corporate bonds, continues to expand. So from that perspective, monetary policy continues to be stimulative. Your question, I think, really obviously focuses on the fiscal side. We had a big package on March 27th in the CARES Act. Now, it's important to realize that some of that stimulus is still in the system. We saw a huge increase in personal savings in March and April. And then since then, we've seen some decline in personal savings, but there's still a ton of liquid assets that have been piled up in the past 6 months or so that I think could continue to provide stimulus for the economy in terms of better than expected retail sales, and of course, money that goes into the market. But if this pandemic lasts another 6 to 12 months, then I think the pressure on the fiscal side to provide another round of stimulus checks is probably going to be pretty intense. But it may have to wait until we get past the elections, because between now and the elections, it's going to be hard to do much in Washington.
Given the monetary policy that you were talking about and the help that we expect the Fed to continue for the foreseeable future, what are your concerns around inflation? And specifically, you wrote you were just car shopping lately. We had consumer prices come out. Right. Used cars had their biggest jump since 1969. So we are seeing pockets in the markets where some inflation is coming back. Are you watching it? Are you worried about it? Could it actually be a good thing? How are you thinking about it?
I'm watching it. I'm not worried about it. And it wouldn't be a good thing if inflation came back in a big way, but having it come back moderately is a good thing, because we did, prior to this recent pickup in the past few months in some areas of pricing, we did see a lot of prices actually decline, with the exception of maybe food prices. So seeing some pickup in used car prices and some other prices that are not food related is a sign that the economy is coming out of this pandemic without that much of a setback so far. So I'm watching it. I don't think inflation is going to make a comeback. I think there's still too many very powerful forces that have been in play for many years, particularly demographic forces, aging demography around the world, including in the United States. And then technological innovation is fundamentally deflationary. And I don't know, maybe we're all going to be racing. A lot of people living in cities are going to be racing to move to suburbs and are buying cars, which is what I gleaned from talking to some of these auto salespeople as we've been looking for a car. But we live in the burbs, so we're not moving from a city situation. But those that are moving from city situations may put some upward pressure on some suburban related prices. But I think overall, technological innovation and aging demography is going to continue to keep a lid on inflation.
All right. Hope you find the right car for you.
Thank you.
Ed Yardeni, always great to get a chance to talk with you. Have a fantastic weekend. Ed Yardeni, of course, is Yardeni Research Chief Investment Strategist.